Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, retirement specialist and six-time author and fiduciary, Tony Walker.
Well, welcome, folks, to the Worry-Free Retirement. And yes, I am that little man in the sweater vest, retirement planning specialist and full-time fiduciary, Tony Walker. And we're in part 4 of our series, which deals with the opportunities available at Tony Walker Financial and our investment philosophy for savers and helping them worry less about money. And to help us in episode number 4, we're going to turn it over now to our other fellow fiduciaries. So let's introduce them right now. To my left, through the magic of Zoom, is our own Heather Hughes in the Bowling Green office. Then we have to my other left here, my favorite son-in-law, Trey Juergens, and then finally my favorite nephew, Wes Walker. So thanks again, all three of you. I hope you've enjoyed the new format, and we're getting into part 4. Trey's done an excellent job of outlining things, and this is basically talking about the products we sell and the products we don't. But before we get into this, we were talking yesterday as we were preparing for the show, products in general, even in the financial world or in the retail world, that really haven't changed that much over the years. So let's be sure in our time together, we do cover some of the financial products that haven't changed. What were some of the products we laughed about that really have not changed in the last 60, 70, 80 years?
Well, the one which that caught my attention, it was circling the social media world last week, was products that have just, once they were created, have not been able to be tinkered with. And the one is the safety pin. But I think it was in the mid 1800s it was invented, and it hadn't changed a lick. I actually fed that into AI to see if AI could try to optimize a brand new safety pin, and it came up with basically the safety pin.
Well, it looks like the new safety pin created by AI at least has an ergonomic thumb pad. All right, what else? Real quick, Wes, what's some products we talked about that just have not changed?
Hammers and nails have changed very little throughout the years. Umbrellas, a bottle of glue, all these sorts of things, they pretty much reached their peak as far as their usefulness.
Elmer still has the cow on it, I think, don't they?
They do.
I think they do. Heather, you got anything to add to this?
I don't know. They're all good things. I mean, how about the wheel?
The wheel.
Wheel.
Yeah, that goes back to caveman days. I was going to say the toothpick. That's what's funny. You go to a real fancy restaurant, you walk out after spending $80 or whatever, and there's a bowl full of toothpicks as people go picking their teeth walking out. All right, so so what we're going to do, we're just going to kind of go through why did you come up with this particular theme, Trey? Because we're trying to cover 4 different things that really distinguish us, but why do we want to make sure people know there are some products we do not offer? I think they know what we offer. We'll get into that, but
Well, unlike the safety pin or the toothpick, the financial world has no problem tinkering with trying to create these new, better mousetraps. And I think what is hard as a saver entering retirement is you get invited to workshops and educational seminars, and you get pitched all these different products. You have no idea what they mean. And without a game plan, these products could really get you in a tight spot.
How would you know, too, what you need and what you don't know, and what these things are to begin with? The names that they have are so convoluted and they sound so complicated, so it is hard to dissect exactly what these things are.
well, Heather, I was even thinking about that. You've kind of been our annuity specialist over the years. When you first came on board almost 20 years ago, talk about the many different varieties of annuities, and not that they're not that much different, but really when you boil it down, a lot of them are very similar. I mean, how many different types of annuities are there out there now?
Oh, there's tons. I remember probably about 2 years into working, that's when we were first introduced to the income riders on the fixed indexed annuities. And that was just amazing, that we hadn't seen anything like that prior. But yeah, there's new products coming out on the market all the time. Variations on a theme, I would probably say.
Yeah, annuities are still annuities. I mean, their premise has always been protection of principal and hopefully never running out of income, which leads us to, we're going to be putting these up full screen. Aaron's going to be going back and forth on the outline tray. Let's cover what we do provide. And let's talk about income annuities and just some pros and cons. I think you've got some things listed here.
Yeah, so very first product that we definitely use in our planning are income annuities. It's mailbox money. It's something we actually looked it up. You trademarked that back in 2012. It's been what a lot of savers are coming to us looking for.
Mailbox money!
How can I turn this 401k into guaranteed lifetime income? There's Exhibit A. That's an income annuity. And it's something that we can lay into the plan. We've got flexibility of these other products we'll talk about to allow them to have access now, but with that guarantee on the back end.
And they're a wonderful tool, but what are some of the cons, would you say? Because I think we've learned every product has a pro and a con. Heather, what would you speak to income annuities, but maybe sometimes when they're not used properly and they become a con?
Sure. I mean, I think we need to differentiate. There's really kind of two types of income annuities first. There's traditional single premium immediate annuities and deferred annuities, and then there are products with income riders. If we're talking about the first set, once you make the decision to elect income from a SPIA, that's a single premium immediate annuity, or the deferred income annuity, once you make that election, it's irrevocable. So you'll pick your term, either a certain period of time or a lifetime income, and then you can't change that. It's steady income. You can guarantee that. You don't have to worry about losing money. But it is very restrictive in terms of access to funds. They'll send you money, but they're going to send you a specific amount, and you're not going to be able to change that.
And Wes, you on the investment side, you're looking at that split IRA a lot. Sometimes people have been a client for several years. Maybe they're drawn on Schwab. And then they talk about, well, what about that mailbox money on the back end? How do you address that with people in terms of when we use it? And back to Heather's point, sometimes we like to defer just to keep the flexibility open.
Well, that's a big piece of the puzzle in retirement. If you do have an income annuity, when are you going to turn income on from it? What helps a lot in my role is that I've got a game plan that I can look at when I'm talking to the person who's in front of me. So I can see at least when we were thinking of maybe having them take income. So we might not take it at the exact date that we said, we would take it in the future. Let's just say the income plan says take it at 72, 73. They might say, well, I've reached 72. I really don't feel like I need this income that much right now, and we might continue to defer it into the future if that makes sense. Or they might have lost a spouse, and all of a sudden that income that we showed as joint that would cover both people is now going to be a single income for just one person, so it'll pay out more. So that kind of planning is crucial in a retirement planning kind of sense.
Good point there. And let's next go to another product we use a lot of, and now that interest rates are up, Trey, speak to the MIGA, the multi-year guaranteed annuity. How many of these things have we written in the last 2 years? And again, just 20 years ago, you couldn't sell them because the interest rates were so low.
Yeah, in the last few years, these have been huge for savers. They're always looking for a guaranteed return. These have provided a guaranteed return, but longer than they could find in the sense of like a CD at the bank. So with these companies, they're backed by insurance companies. It is a fixed annuity, but it's locked in for all those years. So we've had these annuity rates, even better, they don't charge any fees. So with our clients, we've been able to move funds into a shorter term fixed annuity that guarantees them a return that they really enjoy without having to charge fees on it.
I think this is a good place to maybe just take a second. The difference between what we're talking about right now, a short-term fixed annuity, often called a multi-year guaranteed annuity. They abbreviate that to a MIGA. So you've got 3 different names running around.
Yep.
These things are very similar to CD products at a bank. They're between a 3 and a 10-year term. Our typical client is buying a 3 or a 5-year annuity. After that term is up, they've received all the interest from it. They could go move it back somewhere else or take the money out. It's very different from the income annuities we just talked about. With an income annuity, they will essentially be drawing on that for the rest of their life.
I would just like to add that these products still do have surrender charges.
Very good, very good. And then look, kind of keeping an eye on the clock here. Let's go over to products we don't offer. So there's other annuities we offer, and included in those types, there's registered linked annuities, etc. But let's get over to products we don't offer, because we're having more and more clients, Wes, pitch these what's called alternative investments. Kind of classify what those are and why we don't sell them.
Well, I would say it's a big sea change between what we were just talking about and alternative investments. So annuity contracts are written through insurance companies. If they're a fixed or fixed indexed annuity, they're very safe. There's a lot of implicit guarantees. An alternative investment is essentially something where you've entrusted a manager to go out and buy something that is not stocks and bonds. So this could be something like private equity. This is where you're buying private businesses, and you're typically an accredited investor if you're doing this, or something like a REIT. And that kind of gets into our, sort of next segment on things we don't offer. We've had quite, REITs in and of themselves are not the worst products in the world. There are some good REITs, but there are a lot of private REITs that are very restrictive in that you can't get your money out, and a lot of problems we've seen from people who've brought them over.
Yeah, Heather, you've had to deal with that, haven't you? Sometimes we try to get these REITs over and service them, but they're a bear. What's the problem with that?
Yeah, it's definitely an issue. REIT stands for Real Estate Investment Trust. Not all are bad. I mean, I don't want to just kind of blanket that it's terrible, but they all are very illiquid and restrictive. So oftentimes, since this is a private firm, they can set restrictions on what's called a redemption or a repurchase stop agreement. So you can't sell these shares on the open market. You have to sell them back to the company that issued them to you. And sometimes, based on their management, they'll say, nope, we're not accepting any repurchase shares. So you're stuck with it. Recently, we've actually seen a client that had kind of a legacy account somewhere else that had a REIT that lost all of its value. So it went from about $19,000 to zero. So you can lose all of your money in these products. So be very wary of promises of big dividend returns. Usually they're, 9, 10, 11%. There is a trade-off to that in the fact that you may not ever be able to get your money out of it.
That's a good point. If you ever hear of a yield at 9 or 10%, we've had a number of people call in asking about these things. Just perk your ears up a little bit. That is high. And there has to be something in there that compensate you for getting that much yield. A CD these days, at the time of this recording, a 1-year CD might be around 4%. If something's offering you 10, there's a reason that they're giving you that much more interest.
And I got to watch my time here because this is the next subject we've got to cover because this is something we really look out for. Why do we use low-cost ETFs? And then I'll let you answer that, Trey, and then maybe Wes, talk about a mutual fund you researched and potential expenses that a client may never see with a potential mutual fund.
Yeah, we always are cost conscious when it comes to laying out our strategies. And I know Wes and Heather, our investment committee, we're always looking to make sure we get good diversification, but we're not going to go chasing something that has high costs embedded in it. We want to keep our costs down. And with these ETFs with low expense ratios, we can do that.
Yeah, and I think I asked you, Wes, I just said, hey, Wes, get online and just find a pretty high expense ratio. Aaron, if you would put this up full screen, we're going to block out the name. We're not trying to be critical, but explain what's going on with this expense ratio and what does that mean in terms of ongoing cost to a client if they were to buy this mutual fund?
Schwab's research tool is very robust. I was able to find something that I wouldn't buy in a matter of minutes there, just looking. What that fund is, it essentially is a short-term bond fund. So this is not some, high-flying, active managed stock market, get what you pay for kind of fund. This is but basically buying treasury bills inside this fund along with some short-term bonds. Total expense ratio is about 1.5%. So that means if you put $100,000 into this short-term bond fund, $1,500 per year is what you're going to pay in fees, and you're going to get a very similar yield to something you would just get from an ETF that was comprised of short-term bonds.
And then our last one, this comes up all the time. And first of all, I appreciate you, Heather, saying we're not necessarily don't do things that we don't do. That doesn't mean it. We just don't offer them, but it kind of falls into that speculative category. How many times, and Wes and Trey and Heather, I just got it yesterday, do people ask our clients, should I be investing in gold? That'd be a speculative investment in my opinion, or silver. And do you all do those types of things? What's your reaction to that, Trey, when we get that question?
That's another one we say, hey, it's not a bad idea if that's what you feel like you'd like to invest in. Unfortunately, we don't do it here directly. A lot of times people want to invest and they go and find these ETFs that are linked to mining operations and, again, very speculative things. So if they're looking for precious metals, certainly they can go and do that. We're not going to be doing it for them directly.
Heather?
Yeah, I would like to add, there is a big misconception out there that gold is safe and silver is safe. But if you look at the charts on those, the value of gold and silver, you'll see how much it fluctuates over time. So I think people think it's safe because it's something physical that they can have, but the value will fluctuate tremendously.
And even one-offs, Wes, even with individual stocks, tell people why we really don't like chasing individual stocks and what would be the definition, in your opinion, of speculation in terms of how we pick stocks?
Well, yeah, so, the stock market is a wide and vast place. There's all sorts of different companies you can buy. There's all sorts of different investments you can make. A speculative stock, in my mind, would be a company without earnings, or a company that is, maybe a biotech company who's got some new patent or something. That sort of thing, to project the cash flows of that company into the future and try to discount them back to today is impossible because there are no cash flows. You don't know what it's going to produce in the future. So that would be a very speculative investment. Going back to the precious metals, Heather brings up a great point there. Looking at the chart for the spot price of silver, this is not gold. And again, I'm not against gold or silver or commodities in general, but in 2011, the spot price of silver was nearly $47. The spot price of silver today is $32. This is with a silver trust. So that's may not be the spot price of the precious metal itself, but if you just track silver and you bought it in 2011, you would still be underwater in your silver investment. And that's gone on for quite some time.
Stay tuned, folks. We'll be right back. Want to know what savers were saying right before the stock market crash of 2008?
At our age, we just don't want to be on the roller coaster of the stock market anymore.
I'm not satisfied with my mutual funds at all.
When you work as hard as you have worked, you do want to be able to start enjoying a little bit of that money.
Stop putting your money at risk when you don't have to. Learn how to safeguard more of your retirement savings by logging on to TonyWalkerFinancial.com or call 877-499-9255. One of the many things that I'm seeing more and more frequently are people coming to me for second opinions, and they are savers who are totally confused and not sure what to do with their life savings. These are people generally just recently retiring, or they're coming up on retirement in the next couple of years. Give you a case in point. A 64-year-old single female came into our office for a second opinion. Now, this particular individual had left an employer about 8 years ago, rolled their 401k over to an individual at a bank, a broker at a bank, and then has been working since funding her current 401k and wanted to know from the broker at the bank when she could retire. His response, as she shared with me, was, "Don't worry about it. You can retire anytime you want." And I asked her, I said, "Well, how did that make you feel?" And she said, "Well, I don't have a game plan. I don't have anything. I just don't feel comfortable just taking his word for it," as she put it. Well, then what does she do? Well, then she has been getting these invitations to dinner seminars. So I guess in search of a second opinion on retirement, she goes to a dinner seminar. And I said, "Well, how'd that go?" She said, "Well, it was kind of interesting. They talked for about an hour, fed us a nice steak, asked us to try to meet with them after the seminar and set up an appointment. I wasn't interested in meeting, and then they gave us our dessert and a to-go box and sent us on our way." I thought that was interesting. And then finally she brought this in. These are becoming more and more prolific. These are retirement educational courses held on college campuses. And folks, again, I got to reiterate, not that you shouldn't go to these. These are conducted by advisors. These are not conducted by college professors, although they're 501c3 organizations. Believe me, the people here are trying to sell you something. And in fact, it goes on to say at the end of this, our instructors are licensed and trained financial professionals with a minimum of 5-year real-world experience. And then it's funny, it goes on to say that the representative will not be offering products that are sold at this event. But earlier it says that if you do set up an appointment with the representative, you're going to have a one-on-one lab session. Now, what in the world is that going to look like?
Welcome to your retirement lab session. Today, we will be dissecting your 401k. So, let me take my 20% and let's begin.
Okay, so let's cover the products we would offer and products we don't, and what's going to happen in terms of the products you're going to be pitched if you go to some of these dinner seminars or educational workshops. Tony Walker Financial, we do offer fixed annuities. The other guys are probably going to pitch a fixed annuity. Variable annuities, we do not do those. In some cases, a lot of these advisors will try to sell you a variable annuity. We don't do precious metals. Again, some of them will. Alternative investments, absolutely not. More and more people are selling those. Be careful of those. Income produced from life insurance. We don't do that. We sell life insurance, but not for income producing assets in retirement. That's scary stuff. A lot of people are doing that. And finally, yes, through our Charles Schwab platform, most people do this. We're going to offer stocks, bonds, and mutual funds. So my thoughts, folks, if you're going to any of these workshops, maybe you have an advisor that's not giving you the lowdown on when you can retire, give us an opportunity to talk. We've made this so easy to do. We call it the 10-minute fiduciary phone call where you and I will talk. To arrange your free phone call, just go to TonyWalkerFinancial.com, TonyWalkerFinancial.com, or call us anytime at 877-499-9255. We'll be right back. Have you recently retired, been laid off, or offered a buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no obligation appointment. Let us help you today. Our client spotlight today features Mr. Garrett Bates and Miss Melody Bates. And Bates, it's so good to have you with us, and thank you for joining us.
Oh, thank you, Tony.
It's an honor.
So first of all, tell us a little bit about what you did for a living. We'll start with you, Garrett.
Oh, I was do the corporate grind for 25 years in the healthcare industry and focused on helping the organization run more effectively.
And then yourself, Melanie.
I'm an artist professionally. I do commission portraits.
Wow. And I understand you had a very big honor. Tell us who you were recently commissioned to do a portrait of.
Oh, well, I was honored to be chosen to paint the official portrait of Governor Bashir.
And that is a beautiful portrait. It's something else. You've got to be proud of that.
Thank you. It was actually a dream of mine to paint a Kentucky governor, and couldn't have picked a better governor to be able to paint.
Can't believe the talent. I'm so impressed. Tell us a little bit about the experience in working with the staff. I'm very proud of the staff and just how we run things here and the operation in general.
That level of quality service and just personal relationship has been, really part of the whole experience for these last really 9 years.
To walk into your office talking about finances, it's more than that. I wanted to share something that was really special that was going on in my life with you at the time. And you're a finance guy, but you're also developed that relationship. You've asked, you always ask us, what are we doing and what's up in life? And, it's just,
you make sure that the financial things match up to the things that we're trying to do.
Looking for an advisor you can trust? Schedule your free phone call with Tony at TonyWalkerFinancial.com or call 1-877-499-9255.
Who can you trust? It's one of the most important decisions you'll have to make. Question is, are you ready? Well, we're here to help at Tony Walker Financial. We care more about you than we do your money, and we have over 3,500 happy clients and an A+ rating with the Better Business Bureau to prove it. Rolling over a 401k, confused about Social Security, maybe you're afraid of running out of money. Learn how to use and enjoy and protect your hard-earned money. Log on now to TonyWalkerFinancial.com and let's get started. As if the following were right out of the pages of my game-changing book, Live Well, Die Broke, the only perfect financial advisor who ever lived, Jesus Christ, tells an interesting story about using and enjoying one's money before it's too late, where in Luke chapter 12, he describes the success of a wealthy landowner who finds himself in an unusually high bumper crop. And then, instead of doing what most people would do, enjoy the fruits of their labor now, he instead gets the bright idea to store away those fruits for some point out in the future. This giddy farmer is so excited about this newfound concept of storing wealth for the future that he decides to tear down a perfectly good barn to build bigger ones. His reasoning for stockpiling more goods for the future leaves him with the feeling of peace and security where he proclaims, "I have plenty of grain laid up for many years, so I will take it life easy, eat, drink, and be merry." While that might have been his plan for his storehouse of wealth for the future, as he's about to learn, this is certainly not God's plan for him today. As Jesus concludes this parable with God proclaiming the following, "You fool, this very night your life will be demanded from you. Then who will get what you have prepared for yourself?" Ecclesiastes 5:13 describes the futility of stockpiling money for the future as basically evil. And therein lies the dilemma with the many hardworking savers I meet on a regular basis who find themselves in the same predicament as this wealthy landowner. They've been told by the financial world that it is their mission in life to stockpile as much money as they can into their 401k plans. However, what the financial world fails to tell them is that if they don't use and enjoy the storehouse of this wealth, then all of this saving has been in vain. The question for you, dear saver, is this: will you be like the wealthy landowner and forget that this life one day might end, and possibly sooner than you think? Or will you instead learn from the advice of Jesus and consider getting with someone who can remind you that in the end, yep, that's right, we all die broke? My advice: don't assume that you'll live forever. And don't assume that by stockpiling more and more money for the future will help you worry less about it. In fact, in working in this field for over 40 years and watching the lives of thousands of retirees play out, I found that in most cases, having more wealth creates not only more problems, but sometimes more worries. Here's the truth about money, folks. While money is a must for living, this money, especially when it is stored away for the future, may create this false sense of security at a time in life that only God can provide. 1 Timothy 6:17 reminds us not to put our hope in something whose future is questionable at best and whose time has not only come yet. No, only God knows that. No, our hope does not lie in how much we have stored away for the future, but rather our hope lies in where our future has already been prepared. A hope that never fades nor can be taken away from us. As I have expressed in my book, Live Well, Die Broke, once this thing called life here on earth is over, it's over. And that's right, folks, we all die broke. The philosophy of die broke means that there is a clear picture today, while at the same time giving us a roadmap for planning for tomorrow. It's a philosophy rooted in faith, but guided by common sense and a clear picture of what you want out of life and what it is you want this money to do for you while you still can. And maybe that's you right now. You're perplexed because you've saved all this money but don't have a game plan in place to use and enjoy it before it's too late. Well, if that's the case, let's see if we can help. And we've made this so easy to do. In fact, we call this the free 10-minute fiduciary phone call, where you and I can talk briefly to see if I can help. And if we can, we are going to meet in person to get you that free game plan, only offered by Tony Walker Financial. So to take advantage of this free phone call with me, log on right now to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com. Click on that little red box and we'll arrange that phone call right away. Internet not your thing? No biggie. Just call us anytime at 877-499-9255. Well, we hope you've enjoyed today's program. We look forward to seeing you next week on the Worry-Free Retirement. But between now and then, if all else fails, you be worry-free and you make it a good one.